Thank you, Araceli, and many thanks to Accounting in Europe and the EAA for inviting me to speak. I want to set the scene by briefly covering three things. How fair value measurement is used in IFRS standards at the moment, what we've done so far. Then to look at what we found from our recent post-implementation review of IFRS 13. IFRS 13 looks at how you measure fair value. It doesn't tell you when to use it, but it tells you how to measure it when you are required to use it. And then finally, to look at the use of fair value in the future, what we might do in terms of using fair value going forward in the context of our revised conceptual framework. So, how has fair value been used in IFRS standards so far? The ISB is sometimes criticised for, having a goal of using fair value measurements for everything. But in fact, as you can see from this slide, the use of fair value in IFRS is quite limited. In terms of when it's required, we have, I suppose, a reasonable list of standards there. But if you look into that, even in that small list of standards, fair value is often only used for a small aspect of the standard. So, for example, with IAS 19 employee benefits, you use fair value, but only to measure the plan assets. You don't use fair value to look at the plan liabilities at all. And for IAS 36 and IFRS 5, we use fair value less cost to sell as part of the impairment model to look at recoverable amount. So if you're thinking about whether assets are impaired, but it's not the main measurement aspect in those standards. In fact, I suppose that at IFRS 9 we use fair value, but not for everything, only for specific financial instruments. So IFRS 3 and IAS 41 are the standards where fair value is required and required for, a substantial amount of the measurement. But when you think about that in the context of all our IFRSs, that's not that great a use. We also permit fair values in some cases, so people have a choice. If they want to use fair value measurement, they can, and that is true for property, plant and equipment, intangible assets and investment properties. In practice, I think only investment properties are frequently measured at fair value or measured by many companies at fair value. Not very many companies, if any, measure intangible assets at fair value. And then finally, we require fair value disclosure for items where maybe you've had a choice of measuring them at fair value or cost, or maybe you measure them at fair value, if you have a choice. So the use of fair value at the moment in IFRS is possibly more limited than many people imagine, or the image that is sometimes projected of how we use fair value. So we recently completed a post-implementation review on IFRS 13. IFRS 13 sets out how you measure fair value. If you're required to use it or you choose to use it under a standard, how do you actually get to that measurement? And in doing this post-implementation review, we focused on specific areas which we identified through outreach with a broad range of stakeholders. So the areas that we focused on in the post-implementation review were the usefulness of the disclosures about fair value, and then a number of specific measurement aspects. This issue, P times Q, the unit of account, is an issue that some people feel very strongly about, whether you should look at the price, an observable price for, say, a share in the market, or whether you should adjust that if you hold a block of shares or not. And people express different views. And some people think we've got the right answer, some people think we haven't got the right answer. We also looked at the extent to which you have to apply judgment, particularly in level 3 measurements of fair value. So IFRS 13 establishes a hierarchy of fair value measurement. Level 1 is where you have observable prices in a market that you can see. Level 2 is where you can get to an estimate of fair value by using observable inputs. And then level 3 is where you don't have observable prices and you don't have all the inputs you need. Not all the inputs you need are observable. And so you need to do estimates and use judgment. And we also looked at how to apply this idea of using the highest and best use for non-financial assets, which is part of IFRS 13, and some people were struggling to know how to implement that. We also touched on 2 specific issues where people were telling us that measuring fair value was particularly difficult, and that was biological assets under IAS 41 and unquoted equities under IFRS 9. And the key message so we put out a request for information on those issues, and the key message that came back from that request for information was that IFRS 13 is working well. Most people find it helpful and are able to use it to get to their fair value measurements. So that was really good from our point of view. Also that it has improved financial reporting. It's not on the slide, but as part of the post-implementation review, we commissioned a literature review, an academic literature review of how IFRS 13 has been used. And the very positive results of that literature review from our point of view was that fair value information is relevant. That was well established in the academic literature. Also, interestingly, it's not just level 1 fair value information that is relevant, but also level 2 and level 3 fair value information is also regarded as relevant. So that was good news from our point of view. It supports what we're doing in terms of fair value and in terms of IFRS 13, how it's working. We got significant feedback on disclosures, particularly about level 3, what sort of aggregation or disaggregation might be useful or not useful, and the costs of developing that information compared to the benefits that they give. And we got feedback, a lot of feedback on this issue of P times Q. Users want to have the measurement based on the observable quoted share price without adjustment. I think they feel that's the best representation of the fair value. Preparers in general would like to make some sort of adjustments. So that is an issue where there's a divergence of view. In terms of what we're going to do with that information, now that we've had it, how are we going to follow up on that? In terms of disclosure, we've also got a disclosure initiative, and we've got projects looking at disclosure. In particular, we've got projects that are going to be looking at disclosures in standards to do a sort of standards level review of particular standards to see if the disclosures there can be improved and whether we can take general messages from that to apply to disclosure generally. And the feedback that we've got from the post-implementation review of IFRS 13 will feed into that project. We are going to continue liaising with the valuation profession. Over the last sort of 10 to 15 years, the techniques for developing fair value measurement have developed a lot and improved a lot, and we want to continue discussing with the valuation profession how that should be done to make sure that we're picking up on all the best new ideas and getting the best possible measurements. We're not planning to do any other follow-up on the post-implementation review because, as we said, from our point of view, the results were very favourable, were very positive, that IFRS 13 is a standard that's working well, and that the use of fair value, that wasn't the focus of the post-implementation review, but the feedback we've got seems to suggest that, by and large, it is working well and there aren't major problems. I know there are some particular issues that are controversial, but we've been through our standard setting process and we've got to where we are. And then finally, how might we be using fair value in the future? How does it fit in with our recently issued measurement chapter in the conceptual framework? So in the new conceptual framework, in the previous conceptual framework, there was very little on measurement, and what there was really not helpful. There was a list of measurement bases, most of which were never used in IFRS standards, and absolutely no guidance at all on how you would choose one rather than the other. So it just wasn't helpful, and the board didn't refer to it when it was making standard setting decisions. So coming up with something on measurement was a priority in the conceptual framework project, to develop something that the board would find useful and would be able to use in making decisions about choosing measurement bases. And what we've got in that chapter is we identify measurement attributes that we think might be potentials for use in financial reporting, and we divide them into two groups. So we've got historical cost and we've got current value. Historical cost is historical cost. We explain in the conceptual framework that it includes the notion of amortized cost in IFRS 9. And we say that historical costs are measures that are derived from the transaction or other event that gave rise to the asset or liability. So if some part of the measurement, it can be tracked back or arises out of the transaction or the event itself, then that means it's in the historical cost bucket. Current value, on the other hand, that is updated to reflect conditions on the measurement date. And there we've got a collection of different measurement attributes that include fair value. So we've got fair value, we've got value in use and fulfillment value, which are essentially the same notion, but value in use is assets, fulfillment value is liabilities. And we've got current cost. And there we say, if you're looking at current value, you are updating the measurement to reflect all the conditions at the measurement date. So in principle, at least, if there's any sort of stickiness in the measure, it's sort of regarded as a historical cost. If it's all updated, it's a current value. That's not quite the end of the story, because we also allow for modifications of the measurement basis. So, for example, if you're thinking about fulfillment value, you might decide, well, in principle, fulfillment value includes an assessment of the entity's own credit risk, and in principle, you'd update that at each reporting period. That would be consistent with a current value sort of perspective. But we do say in the conceptual framework that often that might not give useful information, and therefore it might be that you'd want to customize or modify fulfillment value to exclude your own credit risk. And that is true. We would think about whether we wanted to modify any of these measurement bases. So we might think about modifying fair value in particular circumstances as well. In terms broadly about the information that these measurement bases give, there's quite a lot of discussion in the conceptual framework and some examples. But broadly, we're saying that historical cost, if you're using assets together in combination in some sort of transformative way to produce things, then historical cost can give you useful information about margins, and those margins can be useful, give users useful information. Current value, we say if it's important to users that they get information about changes in prices and in other factors, then that's something that might drive you towards a current value. Just to say briefly, the difference between fair value and value in use and fulfillment value is that fair value looks at things from a market participant perspective. Value in use and fulfillment value look at things from an entity-specific perspective. So those three measurement attributes look at the same inputs, essentially, but from a different perspective. They are all exit values. Current cost is an entry value, a current entry value, and it looks at the price that the entity would pay now for the asset, or what it would have to be paid to assume the liability. And then finally, what does the chapter say about how we would select that measurement basis? And it's saying that the board needs to think about what gives useful information. So it ties it back into the sort of theme that runs through the conceptual framework about relevance and faithful representation. We want companies to produce information that is relevant and gives a faithful representation. That applies to recognition, and it applies to measurement, it applies to presentation also. So in terms of measurement, we say for relevance, think about both the characteristics of the asset and liability and the contribution they make to future cash flows. So is the asset or liability one that's particularly sensitive to market variables? If so, then maybe something that reflects that, an up-to-date measure that shows that variability provides useful information. On the other hand, if it contributes to future cash flows in combination with other assets and liabilities, and you're after information about margins, if users want information about margins, then maybe a historical cost measure might be more relevant. In terms of faithful representation, we want to avoid using accounting mismatches. Now, it is true that the board expects that from this sort of decision-making approach that we will come up with a mixed measurement model. The board does not expect that thinking about relevance and faithful representation will lead to us always picking the same measurement attribute for every asset and every liability. But given that we think we're going to be in a mixed measurement model, we also need to be aware of the problems that arise from accounting mismatches. You know, we don't want to mislead users of financial statements by creating mismatches that arise only because we've chosen different measurement bases. So we have to be aware of that and think of, you know, that's going to be a factor in how we choose the measurement basis. The other thing for faithful representation is we need to consider the effect of measurement uncertainty. Now, almost all measures involve some sort of uncertainty. I mean, possibly the only one that doesn't is a level 1 fair value, where you can actually, you know, see the price, observe the price in the market. All others involve some sort of measurement uncertainty. Historical cost, for example, if you have to estimate the useful life of the asset, you have to think about impairment. So measurement uncertainty is a factor for all the different measurement bases that we've identified. And we certainly aren't saying that measurement uncertainty makes information not useful. Even a high level of measurement uncertainty would not necessarily prevent that measurement providing useful information. But we do think that there are occasions where the level of measurement uncertainty could be so high that maybe another measurement basis would give more useful information. And so that's something that we're going to be considering. We also, of course, think about the enhancing qualitative characteristics, so understandability, verifiability, comparability, and the cost constraints. So we're always thinking about, you know, how much does it cost to produce this information? But again, it's important to realize that that cost constraint applies across all types of measurement basis. It might seem that historical cost is less costly, but that's not true once you start to consider impairment issues. It might be that fair value or a current value seems a very costly way of getting information, but again, that's not necessarily true for level 1 fair value, where there are observable prices. So there's always going to be this balance of different factors. I've reached the end of my time. Yeah, I will stop there then. And it'll be very interesting to see what decisions the board makes.
For this overview of what's going on in ISB now about fair value. So now, Mary, whenever.
Thank you. Good morning. Araceli asked me to spend my 10 minutes talking about how research can shed light on some of the commonly held beliefs regarding fair value. And as I mentioned yesterday when I gave a talk here, when I don't understand something or there is a debate or a question, my natural tendency is to do research and try to figure out what the answer is, apply some rigorous thinking and evidence to the question. And so I'm going to share some of that with you today. I picked 3 beliefs about fair value accounting to talk to you about this morning. The first one is that fair value accounting caused the financial crisis. The second one is that fair value earnings is useless. And the third is that liability fair value changes from changes in own credit risk should not be in profit or loss. I think that was the comment about some people don't think it's useful information. The first study is joint with Wayne Landsman and Amir Amelzadeh, Contribution to Bank Regulation and Fair Value Accounting to Procyclical Leverage, which is in the Review of Accounting Studies. And the motivating question there is, to what extent do fair value and bank regulation contribute to procyclical leverage? Research question, I'll come to explain what procyclical leverage is in a moment. Research question is, how could procyclical leverage occur? Procyclical leverage says when things are bad, leverage should go up because asset values are going down. But procyclical leverage says, no, when things are bad, asset values actually go up, or at least the banks engage in behavior in which those assets go up. So how does leverage decrease when credit risk increases or when there's trouble in the financial markets? So the first thing we do is look at that. Second thing is, then we go to the data and ask whether banks actually exhibit procyclical leverage. That's what we find in prior research, and we make sure that holds for our sample. Does a bank regulatory leverage constraint cause it? Is that what explains it, or is it fair value accounting? And then do the answers to these questions differ in economic upturns and downturns? Of course, you're always concerned about the crisis, but you want to know whether it happens most of the time. So how does the story go? In the crisis, there were exogenous negative shocks to asset prices. Banks recognize losses, leverage increases, banks sell assets, banks' leverage decreases. But if asset sales are excessive, they sell too many assets, then leverage ends up being procyclical. And then there's this feedback loop people talked about. There's a further drop in asset prices, more banks sell assets, and it goes around and round and round. And this is the contagion effect. You keep getting more procyclical leverage, and of course everybody thought this was because of fair value accounting, because we're recognizing these losses in the assets that's causing the banks to do this. But it turns out that accounting leverage and regulatory leverage are different things, and banks have to manage to regulatory leverage. And accounting leverage is dollar for dollar, but the regulators adjust leverage for their capital regulation purposes. And banks have to think about regulatory leverage too, because if they don't, the regulators come in and want to know what's going on. So we focus on the difference between accounting leverage and regulatory leverage to see the extent to which that can explain what we observe. So what do we find? As the first part of the paper is based on an algebraic analysis to try to figure out, as I said, how procyclical leverage could occur. And we find that when regulatory leverage constraint binds, absent differences in regulatory risk weights across assets, procyclical leverage does not occur. So if the algebra tells us you need different regulatory risk weights before you get procyclical leverage. And as I said, we then take it to the data. Banks exhibit procyclical leverage. We find that regulation explains procyclical leverage for banks that are relatively close to their regulatory leverage constraint and contributes to procyclical leverage for others. Fair value accounting does not contribute to procyclical leverage, either in upturns or downturns. So our conclusion is that bank regulatory requirements explain leverage procyclicality during the crisis, not fair value accounting. The second question is, using fair value earnings for firm value is useless. Excuse me. Here the motivating question is, can fair value earnings provide information to financial statement users that's helpful in making their economic decisions, including valuing the firm when they make their buy, sell, hold decision? And if so, how? This paper is joint with Wayne Landsman. It's using fair value earnings to assess value. It's forthcoming in Accounting Horizons. It's really a thought piece. It's not empirical research, but we think the observations that we make are worthy of further study and consideration. The questions that we address here, try to address, is what information is in fair value earnings? And can disaggregation of fair value earnings reveal information that can be used to assess firm value? And I have a couple of slides of how this works to share with you. This slide assumes at the beginning of the year, we expect the asset to generate 1,000 in perpetuity. The interest rate is 10%, something very simple. So the asset value is 10,000. Everything turns out as expected during the year. The fair value earnings is 1,000. There are no unexpected components at the bottom. Everything is very simple. Trouble is, the world isn't like that. There are a lot of changes in expectations as you go through the year. So we added, in the example, added changes in everything: discount rate, expected cash flows, cash inflows, to see how we get from one year to the next. We begin the asset value at 10,000. It ends up being 13,333. You go through the calculation, which you can see here, and fair value earnings is 4,483 in this example. And the question is, what does 4,483 mean? And this is where people struggle. And if you take the fair value earnings and divide it by the cost of capital by 9%, you don't get the asset value of 1,333. And I think that's why people think that fair value earnings is not very useful. But we offer a disaggregation that says, actually, there's quite a bit of information in the disaggregation. You know, the expected return on the asset at the beginning of the year was 1,000. They update the cash flows. Expected return at the end of the year is 1,200. This is what I would call the sustainable or recurring type of earnings that users seem to want. We hear about core earnings and all these things that we don't really know what they mean, and this puts some rigor and some structure around what it is. It's expected return. That's what we'd like to have with earnings in perpetuity. But other things happen during the year, and there are unexpected components. And these are non-recurring components by definition, real non-recurring components, as opposed to special items that companies put in special items that aren't really non-recurring. But never mind, that's a subject for another day. So here, fair value earnings is the change in value. That's what fair value earnings is, absent contributions or changes in the asset base. But if this disaggregation gives a benchmark to assess current performance, you thought it was going to be 1,000 at the beginning of the year. It turned out to be 4,483. Why? And now you can start asking what happened during the year, how much of that was the market, how much of that was management activity. And then the 1,200, as I said, is the sustainable recurring part, and that's the part, if you divide by the cost of capital, you get the asset value, which helps you predict future cash flows. So this is just Fisher Black wrote a paper in 1980 called The Magic in Earnings. If you're not familiar with it, I highly recommend it. It's a lovely little piece. I think he was a closet accountant, and he calls this The Magic in Earnings, but I think this is applying his thought process to fair value. The third paper is the Fair Value of Liabilities and Own Credit Risk with Leslie Hodder, who is here, and Steve Steuben. And the motivating questions here are, do changes in credit risk affect liabilities' fair value? Would net income be misleading if it were recognized? This is, I think, the controversy over own credit risk. So just to give you an example of what we're talking about here and why we think that it is not misleading, illustration. Start with an asset of 1,000, the debt of 800, equity of 200, and then asset value decreases to 900. And what do we accountants do? We debit loss and credit the asset, right? We impair the asset. But the question is, do equity holders bear all of that loss? Because profit or loss is for the equity holders. So debiting loss says the equity holders are bearing 100 of the 100, so 100% of the loss. But the question is, do debt holders share in this as well? Does the value of their claim go down? And if it does, then we should value the liability at 780, just random numbers that I picked. And then, so the equity holders don't share, only share 80 of the loss, not the full 100. Bob Merton, Nobel Prize winner, says, yes, that's correct. The debt holders bear in the loss. But this is the thing that's troubling, because to get to this position, once you've recognized the full impairment, you have to reverse part of it. And so you debit liability and credit gain, and everybody says, wait a second, how can we have a gain when things are not going well? Asset value went down. And I think if we just made the original entry correctly, we wouldn't have to worry about that, because we'd be debiting loss for 80, debiting liability and for 20 and crediting asset for 100. There is no gain. The 20 offsets an over-recognized loss. So this is the intuition, and then so we look at what we do in the paper is we look to see whether equity returns are attenuated when the firm has more leverage, and we find that they are, and that says that equity holders understand that they don't bear all the loss. They understand they don't get all the gain. It's asymmetric because the payoffs to debt are not linear. It's not a 45-degree line, but equity holders understand it. It's just that the accounting doesn't recognize it. We take the machinery that we've developed in the paper and reverse engineer to get assets and values of assets and liabilities, and then we can say a what-if scenario for what if we had recognized this loss in net income, and how would it be? Would it be as strange as people think? And the answer is not really. The directions are as you would expect. You would be recognizing more income, but it's never big enough to offset well, not never, almost never offsets the loss, the gain. So it's a net number that is always in the right, almost always in the right direction. And so it is not misleading. It turns out we were able to look at, make some assumptions and look at the write-offs during the year for companies' assets, and it turns out recognized write-downs exceed this gain. So one of the problems is we don't recognize all assets, so we can't write them down when they go down in value. But the ones we do write down, as it turns out, are even bigger than these gains are, for the most part. So do changes in credit risk affect liabilities fair value? Yes. Would net income be misleading if effect were recognized? I don't think so, not based on what we've done. So just to conclude, like all new ideas, it's good to challenge fair value, although I'm not sure how new the idea is from the topic of the panel. It's the eternal debate, so I think it's been around for a while. Firms have been disclosing fair values of financial instruments, including securities and debt, for many years, about 20 years in the United States now. But it's good to challenge to see whether they align with intuition and common sense, align with economic theory, help achieve the objective of financial reporting. And I think this is a place where research can play a role. We can apply conceptually sound and internally consistent methods to answer these questions, rigorous thinking analysis that are subject to extensive peer review, building on prior research to help complete a picture. We don't have to do everything in one paper for sure. And it's not opinion or advocacy. We're trying to give an unbiased view. And I think this is one way that research can help ensure that accounting is a learned profession as well as a fabulous practical profession. Thank you.
Thank you very much, Mary. Now Richard is going to give us a different perspective.
All right, thank you. So when I was asked to come and talk about fair value today, my first thought was, are we still talking about fair value? This has been a contentious issue from, as you all know, from the start of the life of the ISB, and to some extent remains so. It's not immediately obvious why that's the case, and so I thought I might try and say something about why I think that might be the case. We've heard a couple of, as it were, defenses of fair value. There will be people in the room who are instinctively suspicious, critical, unpersuaded by the notion. And it's worth, I think, trying to explore why that might be the case. So the thoughts here are based on an empirical study of the difficulty of applying fair value to non-financial assets, as Thali mentioned. But the points I'm going to make are conceptual ones. And I think essentially quite simple points, but there's a bit of subtlety in there as well. And I hope will help to get to some of the underlying source of conflict. Okay, so what is fair value? Well, it's essentially an application of financial economic thinking into a space that traditionally is associated with the recording of transactions. And it's unique, right? In the sense that it's the only measurement attribute that's the subject of a full standard. So, it's not Anne has mentioned in the revised version of the framework, the ISB has sort of started to think about other measurement attributes and started to say something about those. But there's no question that it's given a far greater amount of attention to this one. So it's not surprising for critics of the ISB to think, well, it's protesting too much, it's trying too hard, it's working too hard on this measurement attribute and not giving enough attention to others. So it's distinctive in that sense. Now, what is it about fair value? You know, what's special about it? What's distinctive about it? I think there are two things. The first, which Anne described, is in comparison with the other sort of current value measures, is that it's explicitly market-oriented. It represents the perspective of the market participant. The second distinctive feature is that it insists on the generality of that perspective. Now, this is in principle, right? This is not saying it insists on a full fair value approach in financial reporting. Clearly, and again, Anne's slides illustrated that very clearly, that in practice that's not what the ISB is doing. But what it's doing in this standard is saying, this is how you apply fair value, right? So as a measurement attribute, this is how it works. So there's a generalization of the concept to any assets of liability implicit in the standard. There's also, and I think this is what triggers not least the concern about a sort of full fair value world, there's a sort of logic with the framework, a logical fit with the framework as well. If you think about an asset being a sort of stream of future economic benefits and so on, it gets you into a mindset of financial economics, of future cash flows that get discounted into a present value. And that sort of, it all sort of comes together in a sense, well, and in that sense, therefore, fair value is the natural measurement attribute. And then that aligns with the fact that there's a standard on it and so on. So anyway, I think those are the two distinctive features. And the second is the one that's, I think, going to come out being particularly important in what I'm about to try to describe. What's the appeal of a market perspective? Well, this is actually taken from the FASB, but the logic, I think, is very similar to that lies behind IFRS 13. The idea, and I won't read through all of that, but the idea is that markets reveal prices, essentially, that they are external, that they're objective, and so on. So again, it's very much a sort of economist's way of thinking about the world. And it has a very strong intuitive appeal. The market's made universal in IFRS 13. So you are, and again, this will be, I put all the detail there, but I won't go through it. And you'll be familiar with it. The idea is that you either have a level 1, in which case there is a market transaction and you just record that transaction, or at the other extreme, at level 3, you hypothesize what the market price would be if there was a market. And there's all kinds of, in a sense, conceptual guidance as to how you would, in principle, go about doing that. So the idea is that level 3 sort of extends the reach of accounting technique. It doesn't restrict accounting to traditional verifiable transactions. It says, here's a way of thinking about measurement that extends to all possible situations, even when there isn't a market. Now, at level 3, it seems to me that fair value is not particularly distinctive. It's just exit price. And there's also not a distinction, this links to the framework and the revision to the framework, there's not a distinction between reliability and faithful representation in a meaningful way. So if you think about reliability as being able to verify a measure, or the ISB's moved away from that to faithful representation to capture some broader notion of what's being represented in the accounts. But at level 1, if you can reliably represent if you have a reliable measure of fair value, you also have a faithful representation. There's no meaningful distinction between those two concepts. At level 3, however, I think is where the sort of simple but subtle point is, which is whether the concept of being able to faithfully represent a fair value is a meaningful concept or not. So the ISB introduced faithful representation, as just described, to be a sort of broader concept than just verifiability. It sort of describes the situation where you have measurement uncertainty, or you go through a reasonable process for trying to estimate the value of something, even though you can't actually verify it. So moving away from some narrow notion of reliability to some broader notion of putting a reasonable measure on something that exists, even though you can't verify the number, as it were. So the concept of faithful representation, I think, is an important corollary to the notion of level 3 fair value. Now, here's the, this is going to be a slight abstract turn, so bear with me here, okay? If you want the full description of this, it's in this AOS paper. This is just to give you a sort of soundbite of it. But John Searle, you may or may not know of, is a philosopher who one of the things he works on is the nature of social reality. So, okay, so let me just take you through this. He gives the example of a line of stones on the ground, which interested parties agree defines a boundary between properties. What is happening is that the stones are assigned a function of being a boundary, which causes it to be so, even though the function is observer relative and not an intrinsic property of the stones themselves. Okay? The stones act as a boundary because and only because all parties agree this is the case. Now, the point here is that you have something which is socially constructed. It exists only because everyone agrees that it exists, and they act on the basis that it exists. So that the wall acts as a boundary because we agree it's a boundary, and we respect the rights and obligations associated with the boundary because we have a consensus view this thing exists. All accounting data have that property. They all have that, as it were, ontological quality. Now, subjectivity. So it's not an intrinsic property of the stones that they act as a boundary, it's that we convey that property on them. It's a subjective social reality that they exist. Now, but it's an epistemologically objective fact that there is a boundary. It's observable, it's verifiable, it is a thing. So you can demonstrate that this thing exists, even though it only exists because we say it does. I hope that makes sense as an example. As I say, it's a short description. But this applies, I think, to thinking about level 3, fair value. So if you go out to level 1, you have the social, the institutions, the structures, the agreements, the rights and the obligations and so on that create the objectively verifiable institutional fact. So it's not an intrinsic property of a company that it has a share price. It doesn't physically exist in that sense, but it exists socially because we agree it exists and we create contracts that are binding around it and so on. So level 1, you have an observable fact that you can report in financial statements. Level 3, I think this is the core difficulty with level 3, and I think some of the reason why it's instinctively something to be challenged is that there is no such reality. If markets don't exist, those rights, obligations, those conventions, those things that have been in principle agreed haven't been agreed. And therefore, there is in principle nothing to be faithfully represented. So the point is that the concept of faithful representation does not in principle apply at level 3. There's a kind of logical incoherence, actually, to IFRS 13. The requirement to report level 3 is not based upon, is inherently implausible. Now, that doesn't mean that it's not useful. It doesn't mean it's not practically useful and practically helpful for the IASB to have level 3 fair value, and that to be one of the options in measurement attributes. I think it is useful, I think it is helpful. But at the same time, it's also implausible. And that tension is, I think, at the heart of disagreement about it. I just mentioned briefly another project, which this is a paper presented at the IASB Research Forum, which is rather nice to sort of connect those two worlds together here. Concerned with uncertainty in accounting and how uncertainty is captured and represented, and the role of accounting in reporting what we can say that we know, rather than what we estimate about things that we don't know. And so again, the full paper is here, but an argument in this paper is that the asset recognition criteria should be extended in the framework so that you shouldn't recognize an asset unless ex ante at recognition, realization uncertainty is low, or the amortization scheme can be established reasonably reliably. The idea is that if you think towards the income statement consequences of asset recognition, you should only recognize things that either ex post, fair value gains or losses, you can say belong in the reporting period, or ex ante, amortized cost amortization schemes, you can allocate to time periods reliably. If you can't do either of those things, then you're not providing useful information to investors with respect to resolving uncertainty. The reason I mention that is that an implication of thinking in this way actually is it's very consistent with almost all of the IASB standards, but it's inconsistent with IFRS 3 business combinations. So the standard that Anne mentioned, where fair value is widely used, is one in which assets are recognized at level 3 fair value, where these criteria are not satisfied, and so the usefulness test of information with respect to resolving uncertainty also is not satisfied. So a somewhat different but similar perspective looking at the same thing. Okay, thank you.
Thank you, Richard. Alfred?
All right, you've heard a couple of different perspectives on fair value, and I would like to add sort of an economic perspective to some extent. The idea why this is an eternal debate and why do we have the same debate today is like getting interesting. I mean, one could go back 100 years or even longer when the people started doing actual values rather than any cost or whatever. And Gründerzeit in Germany in the 1870s and also later in the US, it was like sort of the norm before people started to think about it and then came up with cost-based measurement and all these other sorts. So I don't want to go into these details, but apparently from an economic perspective, the real question is what has changed and gives the fair value debate now sort of a little bit of a different flavor. And I guess this is two things. The one thing is practice. So we've got a lot of development in different markets, but particularly financial markets. So these have grown enormously over the many years since now. And people in firms would use that for risk management, for hedging, but also do all sorts of financial engineering, which comes up with this kind of question, how to deal with those things, how to account for those. It's not a simple binary decision, take equity versus liabilities. It's apparently not that easy to come up with some sort of thing. And so fair value seems to be something that captures all these characteristics of those things to some extent. The other change that has occurred is theory. So originally there were a lot of accounting theories in the 30s, 40s, trying to figure out how to deal with inflation and things like that. But more recently then the paradigm shifted to financial or finance theory. And there were these grand theories like efficient capital markets, simple, very simple but elegant sort of theories like CAPM. So everybody knows, I mean, it's very nice. People use it. I mean, you know, when they do fair values, when they do value in use, everybody uses CAPM. Everybody knows it's not sort of an ideal measure, and in practice you can show that in many respects there's some flaws when you apply to practice, but it's very elegant. And it also becomes very complex, and there's a big demand for consulting and trying to figure out and go into more details. So there's a big development in theory. So what does that mean? As a consequence, and the status quo is like that, we've got fundamentally different recognition and measurement standards for financial instruments and for operative assets. So these two are very distinct. So fair value actually started very much with financial instruments for the reasons that I was talking about. And the question then is, when you go to operations in the firm, you know, would that be sort of, could we use the same kind of conceptual basis for measurement, or should there be differences? And actually the conceptual framework does make a difference, essentially, based on these things, and we'll be back on those things again. But so the challenge for standard setters in this regard then is there is a lack of conceptual consistency. So particularly when doing a framework, which has now been completed, everybody was searching for, like, you know, this should be consistent. You know, we want to have some guiding principles, and they would apply to all sorts of things. So conceptual consistency. So when you have different ways to measure things, this is not really sort of a good basis to begin with. But also the elegance of finance theory, at least at first glance, right? And the other thing is fair value seems to favor neutral accounting. So this is neutral information, and you weigh everything in a way, and you get those things. So what I'd like to do with my following remarks is to deal a little bit, go into details with some of those questions, but obviously not all of those. So I guess the main thing of my first kind of set of thoughts is like that more information is not always a better thing, at least in economics, right? So, and to give you some glimpse of what I mean with that is just by really assuming that fair value would be the ideal measure and there's no measurement kind of issues around. So you could provide an unbiased signal of market value and everybody would be happy to receive those things. So we start with this assumption, and what I'd like to give you some examples for is like there are situations where this is economically detrimental. So I try to distinguish between price efficiency in a market and sort of economic efficiency, so making the right decisions. So these two things are tied up to some extent, and I'll give you a couple of examples, as I said. So the one thing that all of you, I'm sure you know, is this kind of social value of public information, which was sort of the beginning of this kind of information theory, and this goes back to in the 70s to Hirschleifer, where you have security markets and risk averse and traders and the trade and have a beginning portfolio, and then there's some public information that jumps in, and this actually reduces trading, because once some people know something about you, you don't trade anymore. I mean, there's no risk that you want to share with others, and you basically eventually things break down in the market, and you're stuck with your beginning portfolio, which need not be the optimal one, right? But that's public information. So once you go to private information by firms and letting them present or disclose information about themselves. So there's a kind of area which is now called Bayesian persuasion things, and this is also a paper I have with Robert Gox, where we look at those things in a particular simple setting, where a firm seeks to finance a new project, and they would issue debt, and so you want to know the value of the collaterals. So collateral seems to be important for issuing debt, and so the question is how to measure this collateral, right? So it's not the debt itself, but it's a collateral that's present with the firm. And one can show, if you do like a full fair value here of the collateral, you get the best information about the price of this collateral and the value of the collateral. But actually, once you do this, then you get to the market where so the collateral is sufficient that you can raise your debt. That you would only provide good information essentially, but you provide bad information because it doesn't matter. You assume that as well. But the question then is, would it be better in terms of raising capital to do a positive MPV project? Would it be better to miss some information and sort of don't disclose some information? And actually one can show in that case what you want is getting the financing, right? And so by publishing or disclosing only bad information where you know you don't get the debt, right? If you don't disclose the good stuff, in a sense you can bundle it and you still get financing. Because people, once you commit to disclose sort of negative information, if you don't disclose, people know that it must be good information, and so you structure that in a way that you can get financing as well, and what you can show is you get more areas where you get financing rather than if you just tell it's above a certain threshold, because you can bundle some information below that, including that one. So essentially what it tells you, by not disclosing information to some extent, that gives you better financing terms and improves sort of net present value projects. So. And this is actually consistent with impairment, for example. So you disclose only bad news, but you don't disclose good news. So values up and over the historical cost, for example. There are other examples, and we had a symposium this Wednesday. Was the first symposium on real effects, and I briefly go to the real effects here as well, because what is a typical argument in deciding about what would be a good measurement basis is like looking at all sorts of price efficiency and looking at markets, whether pick up those things and whether prices react to those. But what the real effects sort of structuring is around is like arguing, by measuring things, you change behavior. And these behavior changes might be to the worse in a sense. So it might be the case that you invest, you overinvest, you underinvest, you do things that are not intended by the standard, for example, but are a consequence of the standard. And so I give you two examples here. The one would be short-term and long-term investment. And this relates basically to what the European Union is up to, long-term financing, long-term investment kind of stories. And they would think, at least consider accounting as a way to either help for long-term financing or assure that people are not too myopic in their main decisions. So there is a flavor of this kind of changing behavior sort of thinking in here. So there's a paper by Canodia, and this is a Foundations and Trends sort of survey paper, which I recommend very much, to get a feel of these arguments, essentially. So what's happening is once you have earnings, and they capture short-term profits and some part of long-term profitability, so once you do investment, right? Then investors are rational and update their beliefs based on the information. So if you get too much of information to them, then they will use this signal essentially to also provide information about other things. So you get, suppose for example, you have more like short-term profits being reported, but there is uncertainty about in the market about the profitability of the long-term effects of the project. By over-investing, for example, you can tell essentially investors, give them the signal by you are confident that you're up to the good thing, and so you over-invest and provide sort of a signaling story about profitability of the project. So you over-invest, and there are examples where you under-invest. So essentially, the market always picks it up, right? So this is not a question of market pricing, or but it's a question of whether you use particular signals in the measurement to convey information about some asymmetry that's out there for particular things. And to give you sort of a very quick but I think very nice example, this is by Shin, on market price as performance measure. And assume there is a couple of sort of managers and they all work and there's some final payoff, all right? And the management compensation is based on market price, and market price is a perfect measure of what's going on, all right, in expectation, and the managers have to exert productive effort. So the market is rational and anticipates all the future events very nicely and prices them into the market. So the problem here when you use it as performance measure is that each manager says, okay, market prices those things into, so they're included in there, but then for me it becomes a constant, it becomes independent of my effort. Okay, so because the expectation is already there, because so the market doesn't observe effort, right? So the expectation is there, and so you don't fully sort of realize what your effort does, but it's included in the market expectation. So you look at anticipated price effects, and given that, there's no way you can by your action change that market belief. So actually, the best thing for a manager in this kind of agency theories is not to expend effort. Right? So because there's no direct effect from that, because it's all expectations. So one would then say, oh, okay, but then the market is sort of silly in thinking about what the market price would be. But actually, the market is pretty rational on those things. And essentially, what's happening, the market anticipates no incentives and prices the firm with this low expectation, right? And this is self-fulfilling, so this is an equilibrium. So there are no incentive effects and the market is still rational, fully understands what's going on, but again, we have a very bad equilibrium in this case. So even if you have this sort of these grand things you know, it just doesn't work in many cases. All right, so this is kind of the real effect. So there is an interaction between measurement and what people decide on. So there's real economic effects of different measurement bases. The other thing about sort of fair value, the fair value debate is verifiability or verification. And these are really important characteristics. So in terms of decision usefulness, so one question one could usually ask is, if you want to provide very good, useful information to the market participants on future cash flows, should it be sort of the cash flows themselves or the fair value, which is anticipated and discounted future cash flows, or can it be something else? And so what actually this doesn't say is why would it be sort of the fair value that's most important? So it could be other things about transactions, so past transactions, things like that, right? So there's not sort of a clear distinction whether you would put in fair value in the balance sheet, for example, on all those cases. So it's more the fundamental information that leads to expectations and informs investors about usefulness of those things. And one extreme example of those things is confirmatory value of information. So, in empirical studies, many people do event studies, and so when information comes out, does the market react to that information? But essentially, very often, information is leaked. I mean, there is press conferences, people get that information earlier, and that's not verifiable in a sense. So, you know, so the financial statements has the clear characteristic of being having verifiable information in there, and people, by expecting that later on published financial statements would provide information about things that already leaked to the market or been presented or disclosed by the firm, that generates the credibility of these earlier disclosures. So there's no wonder once you have the information out there and now you have the financial statements, there's no market reaction. But that doesn't mean that that information isn't useful. All right, so that's I think a sort of important message. And then I don't talk that much about contracting here because stewardship kind of paradigms has always been sort of a tricky thing in financial in the framework as well. But apparently you want to have verifiable information very much for any contracting things. One additional aspect with verifiability, particularly when choosing among different measurement bases, is you need to make sure that information that's being disclosed is verifiable, can be verified. And for example, enforcement, we have so many enforcement institutions around financial reporting. And the question is, can they verify management beliefs, for example? And you see all those sorts of things when doing fair value estimates, and then the enforcement agency comes in and says, oh, you know, how did you come up with this forecast and things like that. So essentially what my point here is it's not only the accounting standards that should be good or bad or useful or informative, but it's also the environment, the enforcement environment around those. So suppose you are in a really sort of low enforcement country, for example, then saying fair value might be just sort of a very managed number relative to other countries where enforcement is very good, right? So one might even have to distinguish between sort of the environment of information that's being used in. All right, so I conclude with standard setting challenges. Would we want to have differentiation within standards? So availability of market prices, and people were talking about different levels for value, but you know, should market prices, I mean, so there's always the question whether you have information that's useful for market pricing or use market prices to create this accounting information, right? So this is like the question of causality here. I was talking about operating and financial activities. We have this kind of business model which many people like, others don't like, whether it's the intent of using an asset in a particular company would create different sort of measurement basis or information that would be useful. There's a lot of questions about synergies among assets, and this is the good thing about financial instruments. There's not that many synergies, so it's easier to do fair value than with operating assets. And I guess one key thing, and Richard also pointed that out to some extent, is how to deal with uncertainty, right? And so it might be that once we go to big data these days, that it's much easier to publish information on variances and things like that, where you want to have covariances. So I'm not sure how to deal with those things, but apparently they also feed into this fair value debate, because it shouldn't be the single value, but you might want to have more information about how this comes about. Right? Thank you.
Thank you, Alfred. Peter, yours.
Good morning. Thank you very much, EA. Thank you very much, Accounting in Europe. Thank you very much, Araceli, for allowing me to speak for a few minutes about fair value and analysts. I enjoyed listening to my colleagues. The presentations were very conceptual, very theoretical. I will do the exact opposite. I will take us into the office of the sell-side analyst, who has to deal with fair value disclosures, fair value accounting. What I'm going to do in the brief remarks I'm going to make here is show you two examples of how analysts have dealt with fair value issues, as it were, and then I'll conclude with making a couple of broader remarks, because I do think it's an important issue to see how this category of market participants works with fair values. So for my first example, I want to take you back to 2015. I'm not sure if you're familiar with the company Noble Group. It's a well-publicized case. There's been business school cases written about this. This is the slide that this company saw in its stock price over the last few years, and I'm going to bring us back to February 2015, when an independent research company in Hong Kong started writing a number of scathing reports on this particular company. It highlighted several issues, but in particular, it brought to the forefront the fair value accounting of Noble Group for its commodity trading contracts. Let me step back. Noble Group is a commodity trader, and its business had been growing substantially, and the main sort of thing that they were doing really is engage in commodity contracts, which they were marking to market. And this company here, Iceberg Research, wrote this report to illustrate that actually there was a problem with this, because what they pointed out is that because of the marking to market, the profits of this particular company showed a nice pattern that looks like this, whereas the operating cash flows showed a pattern that looks like that. Obviously, why is that the case? That is the case because they were marking to market, booking a lot of gains early on, being pro-cyclical, if you wish. Now, you're a sell-side analyst who's covering this particular company. This report comes out. What do? Obviously, the phone rings off the hook because your clients want to know what you think about this. And so I'm illustrating this with a report from Morgan Stanley, and I want to make very clear about this. I used to work there. I no longer work there, so I'm not putting this up as a promotion of Morgan Stanley, nor as a criticism. It's just an illustration. Okay, but I do happen to know the analyst who wrote this report, because it was a colleague of mine. Now, what does this person do? This person has to write a report to address this issue, and what he does is ultimately stick to his view in the first few days after these reports come out, but point out that what Iceberg Research has done is a particular view on how to measure accruals and cash flows. And he in his report points out that there's other ways to look at this that actually would make the disparity between the two metrics a lot smaller. Now, that is one thing. The most important thing, though, that I learned from when he wrote this report is that he has this line there that says, where could we be wrong? Where could I be wrong? And he points out that, well, the real problem here is that we just don't know what's going on there. Noble Group had been increasing the volume of these particular contracts, marking them to market, fair value accounting, but the disclosure had been completely lacking. which leaves the analyst in the dark, and therefore, ultimately at that point in time, the analyst could not address this. Now, this saga goes on, and I encourage you to look it up because it's actually quite an interesting story. But this is just one illustration of how tough it can be for analysts to, on the spot, deal with issues that come up in fair value accounting as they hit the market. Second example is more recent. It's Alphabet. So just a month ago, Google reported its earnings. And as you can see, they had a surge in profit, but expenses also jumped. That's the headline. But importantly, and this is what caught my attention, Alphabet's earnings got multi-billion-dollar boost from stakes in startups, including Uber. So what happened was that in the first quarter of this year, US GAAP introduced fair value accounting for non-marketable securities. And this is a Wall Street article that says, here it is, Alphabet's first quarter earnings received a billion-dollar boost from a change in accounting rules that actually relate to measuring the value of Uber. All right, and it was actually 3 billion. It was material. It showed up on the income statement, and Alphabet had a beautiful disclosure indicating that that was the gain on equity securities in this particular quarter. Right. So that's substantial. All right. So again, you're the analyst. You cover Alphabet. What do? Obviously, the analyst is aware that this accounting change is going to happen. So again, I go to the Morgan Stanley report because that's the one I know best. What's the title of the report that comes out straight after that? What's the number? All right, and the question, and I know this is very small, but ultimately, somewhere in the list of line items that the analyst has to present, the analyst shows, this is what I expected, this is what came out. Was the analyst wrong? You bet. The analyst was way wrong. The number that he had forecasted was way smaller than the actual number that came out. Now, this is good. This is information. The analyst actually applauded the change because it allows him and his colleagues to now see a little bit more of the black box that is Alphabet. Because with all these stakes now being at fair value, we get a better sense of what some of these moonshots and all these things are for a company like Alphabet. The problem, though, with the analyst's job is that it's not just about reading these statements and saying something about it, it's about forecasting. So what are you going to do? Well, this is just to show you that these guys are pretty thorough sometimes. But they have a line there, other items, which includes this stake of Uber. And basically what they've done is they've increased the magnitude of the number from being around 1.5 billion to now 4.5 billion, right? So that's a substantial increase, and this feeds into their earnings per share forecasts. How did they look at the number that relates to Uber? Well, the number was around 3 billion, so what did the analyst do? For the foreseeable future, the number of years that he has to put in his report, the number is 3 billion every single year. Now, you may laugh, but if I ask you, well, why don't we all write down the number that we think Uber is going to change in value year by year? I'm not quite sure that we would get it right either, right? So this is the challenge that these guys face. They have to forecast these numbers, they have to put them in their spreadsheet, and they have to stick their neck out and publish them. So it's not that easy. Now, another colleague of mine still works on a lot of accounting issues in the New York office, and he actually wrote about this because he thought this is important change, and he wrote a couple of comments on it, and he says, okay, here's what's happening. It's all fair value now for non-marketable securities. Is this good? Yes, it's good because we get actually new information. Is it bad? Well, it does increase P&L volatility. It also might lead to a new set of non-GAAP measures, and we know them all very well. And it might actually lead, and this is his final point, lead to what he calls a behavioral response. Companies change the way they structure their contracts, etc., to avoid some of these reporting effects. All right? So what is the takeaway, in my opinion, from these two short examples? Well, first of all, there is good news in the sense that I think knowing fair values, and we've heard a lot about how we measure them, etc., I think there is information in fair values. All right, that's the good news. The problem with fair values is that what does it mean for the future? And the example that I just showed you illustrated, you know, it's fine to know the fair value of the delta in Uber for this year or this quarter, but what does that tell us in terms of next quarter, the quarter after, et cetera, et cetera? And that's the job of these guys. They have to put a number, black on white, on a piece of paper. All right, so that's challenging. And this brings me to my broader point. This highlights once again that it's good to think about putting rules together to come up with accounting. But it's also important to think in the same context about how these numbers feed into the market. And this brings to the forefront, once again, management guidance. I'll be honest with you, and this is my personal opinion, analysts will just take the numbers that management tells them, because they have no way of doing a better job than these guys. So that highlights the importance of management guidance. It also highlights the importance of non-GAAP metrics. Companies will vary again in terms of how they deal with certain fair value sort of implications of what goes on in their firms. And this creates challenges in terms of comparability, etc. It highlights also, and I applaud the standard setters for thinking about these issues with primary financial statements, projects, etc. It highlights issues of separating operating from non-operating. I could ask you, do you think Uber is part of the operations of Alphabet? Well, we could argue about that. Where should it be in our forecast of operating income, etc.? And the final thing I want to say is, you may sit here and be skeptical about analysts, and I worked there for a long time, I've seen them do their business. It is actually not an easy job. And here's one quote from a colleague of mine that I want to share with you. We may sit here and think like, wow, these guys really don't look into accounting, or they don't really work with these accounting numbers. One of the main challenges that these guys have is that when they go to an investor presentation, they get the numbers from the companies. Now, the key thing here is that the clients that they serve also get these numbers from the companies. And an analyst said to me, look, I've got 5 minutes with a big institutional investor client. I am not going to spend 3 of my 5 minutes explaining my view on the accounting to these institutional clients. I need to talk about the underlying business, the narratives, etc., to make the case for the stock call. And that is one of the challenges in this market. We can come up with wonderful rules, but we have to think also about like how these things feed into the market. And it's a bit unfair to always put all the blame on the analyst. They are just forced into a particular sort of way of working that makes them subject to choices made by management in terms of guidance, in terms of non-GAAP. And that's part of the challenge that we have with fair value accounting. Thank you.
Well, thank you very much, Peter. Now we can open the debate for the audience. If somebody has any question or comment, there is a microphone, I think, around. So just, if you want to say something, just raise your hand. Sorry, I didn't. There? Yeah.
Hello, I'm Clemence Garcia from Gakshuin University, and I have a question or a comment to the last presenter. And actually, I have one of my relatives who is working in a large French bank, and he is working with the traders. And you were saying that the analysts don't have much time to use accounting information, but I do believe that they are doing much more deeper analysis than the traders who almost do not use accounting information. I mean that, well, the payout ratio or things like that may use partly earnings and some of accounting information, but not precise numbers. So I would like to have your viewpoints, especially about this issue.
Right. I apologize if I said that they don't care about accounting or they don't work on it. They do work on accounting quite a bit. They have sophisticated models that deal with accounting issues. My point was that in the context of fair values, it is very hard to use intuition or inputs other than what management can provide to start estimating a lot of these numbers themselves. And that's why for a subset of numbers like fair value estimates, they tend to rely on the guidance that is given, because quite frankly, that's not their area of expertise. For example, this Uber forecasting 3 years out. But they do, of course, have sophisticated models, I do think, that look into a lot of accounting issues. It was too broad a statement, and I thank you for your question, because I want to narrow it down a little bit. Thank you.
Thanks. Well, any member of the panel also can comment whatever the other member said, because if you want, of course, if you want to add something. In the meantime, anybody else from the audience? Okay. There.
I also have a question for Peter, and that 3-year forecast, since you raised it. It was hard to follow exactly from here, but was that $3 billion each year addition in fair value that was being projected for Uber under Google's?
Correct. So the number was 3 billion. So what the analyst did is, because there's a line there in the spreadsheet, the analyst filled in the same number.
Okay, now that seems
now
to me...
we can all have a different view of what the delta for Uber is going to be, but ultimately that was the outcome that this particular analyst put in there.
Yeah, I mean, that struck me as kind of an absurd way to do it. I mean, no reality whatsoever, just it's what it was last year. Now, presumably it's had years before that where it's significantly less or maybe negative, and now we have a consistent amount. And I agree kind of wonder what you think about that, because I don't know if the investors are being serviced well with that.
Well, those are two different questions. I agree with you that you could potentially do a more thorough job, but Uber is still, to my knowledge, a private company, and going by what we read in the press on some of like the deltas in value because of the last round of funding, etc., I'm not sure that that's representative of what the value of Uber is. So I guess this particular person chose to stick with the number that he was given in an actual audited financial report. Are investors served with this? Well, yes and no. I think investors are served with this in the sense that they get insight from Alphabet on the value of Uber and on the value of its projects. So from that perspective, I think it's a good thing. Are they serviced with this in terms of the forecasting that happens with that? Well, there they need to be clear that there's going to be parts of that EPS forecast that is just, that are just not very well developed, if I can put it like that. So.
Yeah, there is a question there. Two questions, sorry.
Yes, thank you. My name is Micheline Renaud. I'm from Université du Québec in Montreal. So when you talked about working with the fair value, you talk about, I would say, organized countries. So what do accountants, what challenges the accountants has to face when they work in emerging countries? So where the market are not so well organized.
I'm not sure I'm going to be able to give a very detailed answer, but at the ISB we do have an emerging economies group where we discuss issues that are relevant for emerging economies and particular implementation problems they have. So, we do our best to support the implementation of our standards in such economies. I'm not particularly involved with that group, so I don't know how much discussion there has been of fair value and how to measure it. We do put up also guidance. We've got educational guidance on our website. So, for example, there is educational material about valuing unlisted equities. So we do try and provide as much material as we can to help emerging economies.
Okay, thanks. There was another question here at the beginning, second row.
Hello, I am Márcia from Brazil. How can you explain the difference between fair value, reevaluation, impairment, and value in use, please? For Annie or Mary Beth?
So, were you asking about the different measurement attributes that we have in the conceptual framework? So, very briefly, in terms of current value, we've got 4 different measurement bases. We've got fair value, which essentially looks at it's what would a market participant, pay or buy for selling or assets or assuming liabilities. and that has different levels of measurement, level 1 down to level 3. And it essentially takes all the information that a market participant would want and brings it into a current value measure. Then value in use and fulfillment value, value in use for assets and fulfillment value for liabilities, is the same as fair value, except instead of taking a market participant perspective, it looks at an entity-specific perspective. So it's the same inputs as you'd get if you think about level 3. It's the same inputs into the calculation that you'd use for fair value, but instead of thinking about what would a market participant expect, you think, what does the entity expect in terms of cash flows? And then finally, in the sort of current value group, we've got current cost, which we don't actually use in standards at the moment, but it is widely discussed in the academic literature, and we thought it was important to include it in our sort of family of measurement attributes that we might consider. And that's just, what would the current entry price be for an asset or liability? So that's very brief, but the conceptual framework is well worth reading. So I encourage you to look at it. It goes into more detail and sets out the information you get from these types of measurement basis.
Any final question? Here, Keith.
Well, I don't know whether it is the final question, but listening to the panel, one is impressed again with the sophistication of thought behind the fair value concept. You've explained it all very well from your different perspectives, how much thinking is behind fair value, and it's really very well possible to explain why we have fair value now the way we have it. However, from a practical point of view, it's still the case that the simple word fair value can mean very different things, from a simple observable market price to the value of Uber, and really nobody has any idea how to go beyond management assessments of that. And that is part of the problem, because, well, whether we like it or not, people find it very difficult to get their head around the fact that one simple concept, fair value, can mean so many different things. So, does the panel think that despite the conceptual logic in favor of one word, it might be worth the effort to think about moving to different words to describe these completely different things, and so therefore to perhaps conclude that using the word fair value was not a good idea to capture all these different value concepts? So should we get rid of the word rather than the concept?
So I think the challenge there is one of a grey scale. The essential problem I think you're describing is that at level 1 you have something measurable and observable, and at level 3 you don't, and it would be helpful to not call them both the same thing. On the other hand, there's every shade of grey from one extreme to the other, so I'm not sure where you would draw the line.
I would just make the observation that we do exactly the same thing with modified historical cost. Every asset in liability is measured using a different view of modified historical cost. And therefore, we use that one word, but we know it means many, many different things. And I think the reason, at least my understanding, the reason why you use one word for fair value is because that is the objective. So once you know what the objective is, you have different degrees of success in measuring that, but it is the same objective in level 1 and level 3. And we have the disclosures because the estimates themselves have different characteristics because of the nature of the instrument. But the objective of the measurement is exactly the same. So I think in terms of a measurement basis, there is only one, and we do it do it better or worse depending on information you have. It's just like historical cost. That is cost, and then we do the best we can in different things with different assets. And that's what people need to know when they know accounting. So.
If there is any final comment, because it's time to finish among the panelists or whatever. If not, we have done. Thank you very much to the audience, and thank you very much to the presenters.